Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So today's video is all about making your first investment and putting your first $1,000 to work in the stock market. But before we get into that, we do have a sponsor for today's video. So as some of you may already know, I'm very picky with the companies that come on this channel as sponsors. And we've literally only had one other company up until this point because I really don't want to be promoting companies that I don't use and don't, spend my own money on getting their services or anything like that. So that said, I'm very, very happy to be partnering up with Hatch Invest for this particular video. Hatch Invest have been my broker of choice for when I'm investing in companies in the US as a New Zealander. So they offer very, very competitive rates in terms of brokerage, and that's really the main reason why I initially switched across. So I'm someone who, when I made my first US investment, spent $90 US on paying brokerage for that trade through one of the traditional banks, which is extremely high. And when you compare that to Hatch, where you can buy 300 shares in a US company for only $3 US, it looks a bit ridiculous to be using kind of one of the other brokers. So that's the main reason I switched across. Since switching, I've had a phenomenal customer experience. The platform is very, very easy to use, as I'm sure many of you already know, because I know many of you are already Hatch users. So they are the sponsor of today's video. We do have an offer from Hatch, so I will put a link up on the screen here, which is hatch.as/investingwithtom. I'll also leave that link in the description and as a pinned comment down below this video. And if you click on that link and sign up to Hatch and fund your account with 100 New Zealand dollars, Hatch will give you 20 New Zealand dollars and plug that into your account. So literally $20 free money if you sign up with Hatch and fund your account with 100 New Zealand dollars. So with all that said, let's get into the video. Okay, so how do you invest your first $1,000? The first thing I need to say before we get into this video at all is I'm just a guy on the internet. I'm not a financial advisor, so don't take this as advice. Entertainment purposes only, doesn't represent the views of Hatch for that matter either. So with that out of the way, it's an interesting question. I think if you were going to ask 10 different people, how should I invest my first $1,000? I think you probably wouldn't get 10 different answers, but you might get 5 or 6. I think everybody has a slightly different perspective on this topic, and there's a couple of different ways you can go about it. So I'm going to give you my thoughts on the matter and kind of the ways that I would tackle it. And the things I want to keep in mind are, I guess, what we're trying to achieve in the first place with actually making this investment. So the first thing is, if you invest $1,000, unless you happen to be investing in the next Apple when it, is at IPO stage or something like that, the investment is highly unlikely to be life-changing, at least in the next couple of decades. So there's a couple of things that I want to ensure. The first thing is I want to ensure that you have a good experience, so you don't want to lose a substantial amount of money. So I'm not going to point you towards some high-risk stock where you're likely to lose 80 or 90%. So we want some sort of safety of principle, which we always want in an investment, but particularly important when you're first getting started and it's kind of your first experience. And the other thing I want to ensure is actually kind of going to sound a bit counterintuitive, but I also want to ensure that we don't have the opposite happen. I don't want to have a situation where you invest in a company and all of a sudden it triples in a month and you get these, sort of false, this false kind of picture of what's realistic in your investment. So all of that said, it leads me really towards sort of two main options. So the first one, and this is the way that I started personally as well, was to look at something like a broad market index fund, an ETF. So essentially what an index fund is when you go ahead and make your investment, you can essentially buy into one stock, which represents an index, and within that one stock, if it's an index fund, that will represent a small slice of ownership in a large group of companies. So there's some very common index options out there. One of my first ever investments was in the New Zealand Top 50 Fund, which is FNZ.NZ if you were to search that as kind of the stock ticker. So that will diversify you instantly across 50 different companies, and the advantage of that is you don't have to go out and purchase 50 companies individually, kind of one at a time, to get that same effect. You're instantly diversified. And one of the cool things you can also do is you can set that investment up to automatically reinvest any dividends or any cash payments that those companies are making. So if you don't already know, it's very common for large profitable companies to pay cash out to their shareholders on a regular basis. And one of the great things that we can set up with something like an index fund is we can actually take those cash payments and automatically have them set up to just purchase more shares, so that the next year we've got a little bit more than $1,000 or a few more shares in each of those 50 businesses with the NZ Top 50 example, and it will buy slightly more shares with slightly larger dividends every single year. And that's one of the cool ways that stock market investments can kind of snowball up into something substantial. So that would really be the first thing I would look at, would be something like an index fund. You're not going to get super rich overnight. You're probably not going to lose a lot of money overnight either, which are basically the two things that I would kind of like to see with a first investment. So that's the way I think about it. There's plenty of options, and these aren't recommendations or anything. They're just kind of things you might want to look into. NZ Top 50 is a common one. If you're looking for something in the States, something like a Vanguard S&P 500 index fund is really common. That's what Warren Buffett always recommends if you want to not pick individual stocks, if you just want to diversify across an index. There's a million different ETFs out there, so go check them out. I would tend to steer away personally from kind of individual sector ETFs. So there's lots out there where you can invest just in energy or just in environmentally friendly companies and whole bunch of different stuff. Personally, I think you just buy the whole thing, buy the whole pie. If you want to invest in some American companies, buy an S&P 500 index fund that will instantly diversify you across 500 companies. So that's sort of option number one. Option number two, if you want to, take a little bit more risk and you're more interested in individual companies, would be to pick one or two companies that you already know really well. So something that you're a customer of. A good example might be someone like Apple or someone like Samsung, if you're not an Apple fan. Really well-known companies that you already spend your money on. So I don't know, I went to McDonald's after the lockdown ended, so maybe McDonald's. Facebook, I'm sure you all know. For some reason I've got a mental block, but there's a gazillion different companies out there. Many of them are public, large, very profitable in the US, pay out lots of dividend money, relatively safe investments, and great place to kind of park your money as a starting point. So those would be the next things I would look at. I would say if you're going to invest in an individual company, there's definitely a little bit more research that you're going to need to do. So that's what a lot of the videos are about on this channel, but just to give you sort of a basic run through of some of the things that I look at. First, make sure I understand the business, and that's really the reason why I said look at businesses you already know. If you're a customer of it, it's very likely that you already understand those businesses quite well. So make sure you understand it. Make sure that it has some sort of competitive advantage and won't be taken out, doesn't have a high risk of being taken out by competition over the next couple of years. So anything with a really solid brand like a McDonald's or a Coca-Cola is not going to disappear in the next year because a competitor comes in. Companies can disappear because they're poorly managed, or they have too much debt, or they're losing money, all that kind of stuff. But they're not, McDonald's isn't going to go out of business because, Joe's hamburger restaurant comes out and steals all their customers or anything like that. So look for things with really indestructible brands, or things with other types of competitive advantages like network effects. So for example, Facebook is a great platform, and Instagram is a great platform because all your friends are using it. So that's something called a network effect. There's a good reason that if I went and started my own social media company, it probably wouldn't be very popular, because I'd be the only one on it for starters, and there's no advantage to, all these people overseas or in other parts of the country that I don't know signing up, because there's no network there. There's no one else's friends are kind of using that platform. So Those are the types of things you want to look for that will really keep a company alive long term and have it prosper. So that's the second thing. The other thing I would look for is do a little bit of digging on management. At the end of the day, purchasing shares on the stock market is simply buying a piece of ownership in a business. So if you're looking to purchase shares in McDonald's, for example, do a bit of research on the guy or girl. Unfortunately, most of the time it is a guy who is running one of these big public companies. So do some research on that. Watch some interviews that they've done. Read some letters on how they talk to shareholders, and make sure that that manager is trustworthy and has a good track record with running that business. And then the last thing, which I like to pay particular attention to, is making sure that you're able to buy the business at an attractive price. So regardless of how high quality a business is, you can overpay for it and turn a great business into a poor investment. So there's a couple of videos on the channel already going through valuation and how I kind of approach that. Just to give you a quick analogy that I always like to use, I like to think about these things like a real estate investment. So if you were buying into a rental property where you had a reasonable rent that you got for that property was, say, $10,000 for a year. So if you get $10,000 for a year in rent and you're able to purchase that property for $100,000, which you cannot do in New Zealand, but if you're able to do that, that is a very good rental yield. That's a 10% return on your investment. So that's the way I like to think about these businesses as well. That's all you're buying cash flow at the end of the day. So if you've got a business that's making $10,000 a year, it's not very rational to pay $200 million for that business. So unless you expect that $10,000 is going to grow to many millions in the future in terms of earning power. So think about businesses just the same way. Think about stocks exactly the same way, because that's what you're buying at the end of the day. And my final tip that I would like to leave you with is to have a long-term time horizon. So we've gone through understanding the business. Does it have a competitive advantage? Is it well run? Can you get it at an attractive price? The other thing, which is more unrelated to the company and more related to yourself, is making sure you have a long-term time horizon. So even if you make a great investment, purchase at an attractive price, all that kind of stuff, stocks can go down very quickly, they can go up very quickly, and it is pretty much always a good idea to just hang on to those companies if they are truly great businesses. So don't get too caught up in the fact that maybe you're down 5% or down 10% or down 50% for that matter. That stuff does happen, but at the end of the day, very, very strong franchises and really well-run businesses generally come out the other side okay. So those are my top tips on getting started with investing. I would love to hear yours if you've got any more as well that I have missed. I will again leave that Hatch link up on the screen here, so feel free to go check that out. But that's all from me today, so I hope you enjoyed the video and I will see you in the next one. Cheers.